Here is my recession-proof investment plan for 2024. I'm going to explain this to you in 3 simple, fast steps. Step number 1, let's go over what's cheap right now. There are some fundamentals for investing. You got to buy low, sell high. And that seems very simple, but it's not easy. There's a big difference. Let's cut to this clip from my favorite investor of all time, Jim Rogers, and you'll see what I mean.
What is your personal philosophy when it comes to managing money?
Buy low and sell high.
That's a pretty easy one. You can give us...
Oh, I know it sounds easy, David, but it is not easy. It sounds so easy and it sounds so wonderful. And you see people on TV and you say, I could do that. I could have bought Apple. Ha. The problem is knowing what is low and what is high. That's the very difficult part. I have learned over the years to try to find things that are ignored and that are cheap because people ignore them, but where there's a positive change taking place. If you can find something cheap where there's change, good change taking place, you might make a lot of money.
So the key here is not just buying low and selling high, or buying things when they're cheap and selling them when they're expensive. It's to find things that people ignore, where there might be some sort of positive change, a catalyst, if you will. So first and foremost, let's look at commodities. Why? Because I think we're in a long-term super cycle. Editor, go ahead and throw up that chart. We can see that in 2020, we likely bottomed out. And these super cycles last 10, 15 years, sometimes even longer. What's weird is this really isn't on too many people's radar. They'd much prefer to chase that shiny object, whatever it is. The meme stocks or the most recent AI stock as an example. But if you study history, like Jim Rogers does, you realize that the real money is made by buying things that are totally off the radar, by buying things that people ignore. So now we've got to ask ourselves, what's the positive change? Let's think about the direction the world is headed right now. Unfortunately, and I say that because most of you, just like me, value freedom, liberty, and free market capitalism, the world is headed towards more and more central planning. Well, we know what the central planners want. They want to lower the population and they want less energy use. So they're going to push this ESG harder and harder and harder. Well, the more they try to transition the entire world onto wind or solar, that's going to mean less investment going into the commodities that we need to survive. Like fossil fuels are just basically digging holes in the ground. Now, I know many of you right about now are saying to yourself, okay, George, but the governments, although we don't like them, they're going to push everyone into these electric vehicles. They're going to push everyone into this green movement, like the Green New Deal or the Inflation Reduction Act, whichever you prefer. But this is the way the political winds are blowing. All right, what you're doing is you're making the mistake of thinking that demand is always going to stay the same. And the demand that we have today will be the demand for energy that we have tomorrow. But that's not true. You see, demand for energy always goes up as long as there's people in the world that want to improve their standard of living, because you can't do that without energy. So what's my point? Editor, go ahead and throw up a chart of energy use going all the way back to the 1800s, where our main source was biofuels, literally like wood and cow dung. And then we discovered something called coal, which was fantastic because it was far more energy dense and therefore much more efficient. And then we go from coal to oil, oil to natural gas to nuclear, wind, solar, etc. But every step of the way, we never use less of the prior source of energy. In fact, usually we use more. So my point here is energy is the economy, meaning that energy is equivalent to the global standard of living. And I can promise you, people in South America, people in Asia, people in the Middle East, people in Africa, all over these emerging markets, they want their standard of living to improve, and they're not going to let anybody get in their way. And that's going to require more and more energy. And therefore, even if we transition to wind and solar or whatever else comes next, it doesn't mean that we're going to use less of coal, oil, natural gas, and biofuels. If history is a teacher, we'll use the exact same amount, if not more. And this is an example of the positive change that Jim Rogers is talking about. Because the demand stays the same, but the supply goes down. Because of the central planners, there's less money going into additional supply. So now that we understand the basic principles, let's go over a couple charts of what is getting pretty darn cheap right now as we speak. Now, I want to be very clear. This is not investment advice. This is just basically me sharing with you what's on my watch list and what my game plan is in 2024. So we start by looking at a chart going back to 2018 to today's date. On the left, we go from 0 all the way up to 600,000 yuan. Now, I have no idea why this chart is denominated in the Chinese currency, but it doesn't really matter. There wasn't that much of a price swing between the Chinese yuan and the dollar. So overall, the price move would be similar, whether it was in Chinese yuan or dollars. Okay, so this is lithium. Now, one thing I want to point out, this is nominal. This is not adjusted for inflation. So if you adjust for inflation, these prices would be even lower than what we're going to be comparing them to, and that would be 2020 during the cerveza sickness. So lithium is fantastic, especially if you like batteries, if you think everyone's going to transition into driving Teslas, we're going to electrify the economy. Well, we're going to have to dig a lot of holes in the ground for things like copper, nickel, and lithium. So we had this huge, massive run-up, and the price has absolutely crashed. Now, right now, it's around maybe 100,000, 130,000, something like that. So it might be considered cheap. I don't know, I'd have to ask Jim Rogers. But what I'm doing specifically is waiting for an opportunity where it gets down where it was when everyone thought the world was coming to an end in 2020. Now, will it get down that far? I don't know. Will I buy before then? Maybe, maybe not. But this is how I'm looking at the chart. What I like to do is look at a commodity price, adjust for inflation, and then look for a historical average and see how far over or under the price is from that historical average. And if it's gone all the way back down to where it was when we were in economic crisis mode, then for me, that's something interesting, and that's something I want on my watch list. Now, if you want to talk about something that is ignored, let's talk about the next chart. That would be coal. This is one of my favorite commodities moving forward for all the reasons we just discussed. And before we move any further, I want to suggest a book that I read. It's called Hot Commodities from, you guessed it, Jim Rogers. And this is a book he wrote around 2002, 2003. It came out, I think, in 2004, but he was talking about his favorite commodity at the time, and it was something called lead. Now, for those of you who are around my age, you remember that lead was persona non grata. That was the worst commodity. We were trying to get rid of it. It was in the paint. It was maybe in people's pencils. I still don't know if that's lead or graphite. But they were trying to ban it. It was like asbestos because it was getting in kids' bloodstreams and just wreaking havoc. So the price completely crashed. But what Jim Rogers pointed out was demand was going to stay the same, if not increase. Why? Because although Americans were stripping it away from their paint on the walls in their house, the Chinese were using it for batteries that you put in cars. So what ended up happening is the supply plummeted because no one in their right mind would invest in a lead mine or the production of lead, but the demand was still going up for reasons in the emerging markets outside of the purview of the people in the West. And I think we could see the exact same phenomenon play out with coal. And what's fantastic is we can see where the price was all the way back in 2020, going back to that benchmark, and then it absolutely skyrockets, goes parabolic because what happened with Russia and Ukraine. But since that time, it's completely crashed. It's not all the way back down to where it was, but it's getting darn close. And it's not just lithium and coal. It's also things like natural gas. In fact, let's go to the exact same website, Trading Economics, and look at the specific data. We can see that year over year, lithium is down 78%, coal down 66%, natural gas down 60%. And what's even more exciting is these commodities could get even cheaper. If we look at the yield curve, that's predicting a hard landing or a recession, if you will. And if we go into a recession in 2024, the probability is very high that the prices of all these commodities, even lithium, coal, natural gas, go down even further, possibly, hopefully, to a level that we saw back in 2020.
Step number 2, the next fundamental that goes into my recession-proof investment plan for 2024 is risk and reward. What most people do is they just focus on the upside potential. Oh my gosh, if I just buy this stock, or oh my gosh, if I just buy this piece of real estate, it could go up by 10, 15, maybe even 50% over the next 2 or 3 years. Okay, that's fine, but what's your downside? And if an asset can go up by, let's say, 10 or 15% next year, but your downside is 20 or 30%, that's not a good play. What we want is the opposite. We want asymmetry. We want an asset that could go up by 100, 200%, but most likely would only go down by a maximum of 5%, just using that as an example. So this takes me right over to a recent article from the Wall Street Journal. Title: Owners keep zombie malls alive even when towns want to pull the plug. I'm sure a lot of you watching this video right now have a mall in your local area that would fit into this category. It looks like a zombie. It looks like it's on its last breath. It's dilapidated. The weeds are growing. No one's in the parking lot. There's no stores. And you're just waiting to see how long it's going to take before it's demolished. And I'm not saying go out there and buy a mall or some sort of REIT that invests in malls. But what I'm doing is using this to illustrate the concept that I am using to try to build that recession-proof portfolio for 2024 and beyond. Let's get back to the article. Malls typically sit on large parcels of prime real estate, which often include nearby buildings such as restaurants, as well as large parking lots that can be subdivided and sold in parts, sometimes at values exceeding the purchase price of the mall. Very important there. Let me read that again. Sometimes at a value exceeding the purchase price of a mall. So think about that. If you can subdivide something and you can sell off the parts for more than you paid, what's your downside risk there? Effectively, zero. But yet, there's a lot of upside. More on that in just a moment. The partners or the investors that buy these malls keep the malls open. They continue to collect rent from the mall's remaining retailers. When national retailers move out, then they replace them with quote-unquote non-traditional tenants such as call centers, local small businesses, doctor's office, and bounce house venues. I think those are the things for those, like kids' parties. Now let's get into the details, some specific numbers. In June, Namdar Realty, and this is the investors that they use as an example throughout this story, purchased the Crystal Mall in Waterford, Connecticut for $9.5 million. I know a lot of you right now are saying to yourself, $9.5 million for a dying mall? Who on earth would do that? Again, going back to what Jim Rogers teaches us, you've got to look for things that people ignore. And I don't think there is any asset class on the planet Earth right now that people are ignoring more than commercial real estate, office buildings, and dying malls. But this group bought this property for $9.5 million. It was appraised in 2012 for $153. Now, I'm not saying that just because it went from 153 down to 9.5 that it was a good deal. you've got to look at the asset relative to the price. So now let's look at the specifics of this asset they purchased for $9.5 million. In addition to the nearly 800,000 square foot enclosed mall, this deal included a connected building occupied by Target and several freestanding buildings that were leased to fast casual restaurants. So what they end up doing is they subdivide these properties and they sell the land underneath the Target and the fast food properties such as Wendy's, let's say, to recoup their cost. Specifically what they did is they sold the Target its building or the land under the building for $8.9 million. Then they sold the parcels occupied by the restaurants Wendy's, Friendly's, Figaro's, Popeyes, and Raising Cane's for sums ranging between $1.1 million and $2.6 million. And with the space that remains, they can fill them with these alternative tenants, such as a boxing gym or maybe one of these bouncy castle places or a call center. And what they've done is they've basically been paid to have a massive amount of cash flow coming in every single month. But that's not their exit strategy. Then what they can do, when the price makes sense, they'll sell it to a developer that will demo them all and then build apartment units or whatever it is. An example here would be a recent property in New Jersey they just sold for $43.25 million. I'm not saying that I'm going to go out there and start buying malls, although after reading this story, it seems like it might be a very good idea. These are some fantastic numbers. No, but all joking aside, the reason I wanted to go over this story is to show you this concept and this strategy that I'm going to be implementing in my own portfolio moving into 2024 and beyond, for that matter, where you're looking at this tremendous asymmetry where there's very little downside and tremendous upside.
Step number 3, my third fundamental for my recession-proof investing plan for 2024 is timing. You got to time this stuff right. Now, there's a saying out there that it's not about timing the market, it's time in the market. And I want to debunk that right now, once and for all. Editor, go ahead and throw up a chart of the S&P 500 adjusted for inflation from 1928 to 1980. And we can see that it went up by basically 0%. It was flat. So if you invested in the S&P 500 in 1928 and held your position for 52 years, when you adjust for inflation, you would have made $0. Anyone that tells you this nonsense that it's about time in the market will only show you a chart conveniently going back to 1980. We call that cherry picking the data. If you look at all the data, it becomes crystal clear that you need to be very strategic about when you buy, which takes us right to our chart that goes back to 1990, actually a little before 1990, maybe 1989. All the way to today's date. On the left, we go from 0% up to 10%. This is the Fed funds rate. So let's look at this. Going back to 1989, Fed funds right around 10%, and then they started dropping rates. But then what happened in 1990, 1991, after they started dropping rates? That's when we had a recession, as represented by this red arrow. The exact same thing. .com, exact same thing, GFC, and you guessed it, the cerveza sickness. Now we've got a big question mark right here. It's interesting. They dropped rates right here, but nothing hit the fan. We did not have a recession. So what was going on? Well, we have to remember that if we look at the yield curve, it wasn't inverted. Long-term rates weren't dramatically under short-term rates, which has preceded a recession every single time, going all the way back to 1950. So this timing that I'm referring to in step number 3 is only applicable to when we have a massive inversion in the yield curve, which we have today, right now, as we speak. So the whole point is the stuff usually hits the fan. We have a recession, a hard landing, a crisis, a collapse, whatever you want to call it, after the Fed drops rates for the first time. Now, we're talking about probabilities. There are no certainties, but you have to assume that the probability is high that this time it's going to play out the exact same way. So what I'm doing from a standpoint of timing is I'm sitting back and waiting. I'm not doing anything. I'm building a watch list based on step number 1 and step number 2 until the Fed drops rates for the first time. And when they drop rates, that's not a bullish sign like everyone thinks it is in the mainstream media and on financial Twitter. That's a bearish sign if you look at history. You want proof? Let's go ahead and throw up a chart of commodities, or actually asset prices, before and after a recession. We'll focus on commodities. And we can see that most asset prices go down dramatically after the official recession starts. So if we can safely conclude that the recession usually starts after the Fed drops rates for the first time, we can also conclude that the prices of the stuff that we want to buy for our portfolio will likely go down as well, giving us that optimal opportunity. So my recession-proof investment plan for 2024 is to sit back, watch this chart like a hawk, watch the inversion of the yield curve, T-bill and chill, and then once the Fed drops rates for the first time, look around, see the carnage, look at my watch list based on what's being ignored, the positive change, and risk reward, and then take action. And for those of you who have further questions, you want more in-depth analysis, or maybe you want to find out specific stocks that would be perfect for this strategy, you can check out my membership site, Rebel Capitalist Pro. It's the investment community that I have with my good friends Lynn Alden and Chris McIntosh. There's live stream Q&As with the pros where you can ask them any question you want. There's incredible research, and there's model portfolios, so you can see what they're buying right now and what they'd like to buy in the future moving into 2024. You can see how they are recession-proofing their own portfolios. And on top of that, there's the incredible Rebel Capitalist Pro community. If you want to check it out, you can go to georgegammon.com/pro, and we'll put a link in the description right below this video.